My name is Ray. Welcome back to another episode of Ray's Investment Clue Book. Today we'll be talking about categories of financial assets. So there are four main basic fundamental categories of financial assets. That is cash and cash equivalents, equity, fixed income securities, and derivatives. So cash and cash equivalents. The common saying is cash is king, and for good reason, because cash is a safe haven. It's safe. You basically have a close to zero chance of loss, and so cash is basically one of the largest and maybe the most fundamental asset class. Cash, there's two types: cash and cash equivalents. Cash is basically money, paper money, and coins. Checking accounts, which are close enough to cash, close to cash. Money orders and undeposited receipts, all close to cash and counts in this category. And cash equivalents are basically short-term and liquid part components such as commercial paper, preferred stocks with less than 3 months maturity, treasury securities, money market mutual funds, and we'll definitely discuss about things like money market mutual funds more in the future. But as of now, because of their liquidity and because of their short-term contract, they are counted as cash equivalents. And cash equivalents, especially during recessions, are an extremely important asset class and also extremely ignored at times, because cash minimizes risk, and sometimes you're not trying to be aggressive in your investments. You're trying to preserve your capital, and the best way to preserve your capital is cash. So above cash is equity, and equity is basically ownership in a business, and basically claims on the firm's equity or profit and future profits, claims on the future liquidation if there's liquidation, and proceeds from liquidation. Of course, this comes after bondholders. Bondholders have the highest stake in liquidation, and of course, equity comes in the form of stocks. Preferred stocks, common stocks are both claims on a business's equity and business's future profits. After that is fixed income securities, which is often the largest market here. Fixed income securities are basically what their name describes. They're securities with a fixed or not necessarily guaranteed, but a stable or specific amount of return on a certain basis. And so fixed income securities, of course, most commonly we think about are treasury bonds, government bonds, and agency bonds. Of course, there's also junk bonds in a way, or high yield / distressed bonds, investment grade bonds, municipal bonds, other securitized products, and just in this general aura altogether is just fixed income securities. And lastly, and most volatile of them all, is derivatives. And derivatives are basically based off of an asset, maybe an equity asset commonly. And derivatives are, and since assets such as equity can already be quite volatile, you can imagine derivatives are even more volatile since they're based off of potentially already volatile asset. So derivatives are based off of a primary asset, such as a security originally sold to raise money by a business, government, etc. And derivative asset, basically its value is derived from an already existed trading asset. So as a result, it can be complex, and there's a lot of leverage already embedded since it's already derived from an existing asset. So a lot of leverage is derived from it. And leverage is a beast, basically. Leverage can, if you know how to use it, you can have crazy returns, but also you can also be bankrupt in a blink of an eye with leverage, and just derivatives in general. And so as a result, you can probably imagine most modern financial crises are derived from derivatives. Derivatives are such a volatile instruments. So derivatives, of course, you can see is a very complex market. There are two main types of derivatives. There are exchange-traded derivatives, basically almost like exchange-traded stocks. They're officially traded on a certain exchange, such as like maybe New York Stock Exchange, except for derivatives. And so these are things like commodities such as gold, silver, crude oil, very fundamental and basic derivatives. And of course, there are also over-the-counter derivatives, which are basically kind of like one-on-one trading between investors. It's kind of like a free-for-all almost. And it's basically for things that you can't find in exchanges, such as financials, such as single stock futures, equity financials. We have interest rates too. Interest rates are very complex and volatile, and the currency derivatives, such as just the currency market in general. So that's all we're going to talk about today. Just the four main types of assets. And thank you. See you next time.